War headlines are dominating the news again. But here's something investors often misunderstand. Wars themselves rarely crash markets. What actually moves markets are energy shocks, because when energy supply is threatened, a powerful chain reaction begins. War leads to higher oil prices. Higher oil prices push inflation higher, and higher inflation forces central banks to react. That chain reaction is what ultimately moves markets. If you understand that transmission mechanism, you understand how geopolitical shocks affect your portfolio. And that's exactly what we focus on here at Weekly Asset Architect. At Weekly Asset Architect, we focus on the transmission mechanisms behind market shocks. Geopolitical events rarely affect markets directly. Instead, they move through three stages: energy, inflation, and policy reaction. When conflict threatens energy supply, oil prices rise. Higher oil prices increase transportation costs, production costs, and consumer prices across the entire economy. That feeds directly into inflation. And when inflation rises, central banks lose the flexibility to support markets. That's when geopolitical risk stops being short-term volatility and starts becoming structural risk for the global economy. History shows this pattern very clearly. If we look at major geopolitical conflicts since World War II, markets tend to follow a similar sequence. First comes the shock. Markets drop as uncertainty spikes. Then prices stabilize once investors understand the economic impact. During the Gulf War in 1991, markets recovered quickly once oil prices began falling. During the Iraq invasion in 2003, the market actually rallied once uncertainty faded. In both cases, the key variable wasn't the conflict itself, it was oil prices. So the real question investors should ask isn't simply whether there is a war. The real question is whether energy supply will be disrupted, because that determines whether markets experience short-term volatility or a deeper macro cycle shift. Today, the biggest market risk isn't simply geopolitical tension. It's the potential impact on global energy supply. One critical location investors are watching is the Strait of Hormuz. Roughly 20% of global oil shipments pass through that narrow corridor. If energy supply through that route is disrupted, oil prices could rise quickly. And higher oil prices would feed directly into inflation again, which would force central banks to keep monetary policy tighter for longer. So what should investors actually watch? At Weekly Asset Architect, we track geopolitical risk using something I call the Architect's Dashboard. Three indicators matter most: oil prices, energy supply disruptions, and central bank reaction. If oil stabilizes, markets usually recover from geopolitical shocks. But if energy supply is disrupted and inflation rises again, geopolitical risk turns into structural economic pressure. And today there's an additional layer investors should consider. The global artificial intelligence infrastructure buildout is dramatically increasing demand for electricity as new data centers come online. Many of those power systems are still closely tied to natural gas and oil. That means energy markets are becoming even more sensitive to supply disruptions than they were 20 years ago. Markets rarely collapse because of war alone. They react when war disrupts energy supply and monetary policy. So instead of trading headlines, focus on the transmission mechanism: energy, inflation, policy. That's the architecture behind how markets respond to geopolitical shocks. And that's what we track here on Weekly Asset Architect.